Margaret, thanks very much. I'm joined here by the House Financial Services Committee Chairman Barney Frank, also the chairman of the conference committee that worked into the wee hours of the morning. Thanks for joining us on, I think, 4 hours of sleep. Appreciate it very much. At the end of the day, after this process, it's been months. Is this where you thought you'd end up?
No, I think we have a tougher bill than I was hoping to get. When we began this, there was obviously a lot of opposition to virtually every important aspect of it from people with a lot of clout, and that's including the large financial institutions, but also, frankly, politically even more daunting, the network of smaller institutions that are very important politically because they have people in every district, and because they're good people, they do good things, but they, I think, sometimes overreact about regulation. And what essentially happened was this. Beginning in the spring of this year, healthcare was done. So healthcare was no longer taking all the media attention. And beginning in March, when the bill was being debated in the Senate, the public was paying attention. And you go back and look at the Volcker Rule, which people thought would never go anywhere, Blanche Lincoln on derivatives, the Elizabeth Warren's idea for Consumer Bureau, strict restrictions on being able to make loans and then sell them and not have to keep them, laws against subprime lending. These are things many of us have been trying to do for some time in some areas that were relatively new in others. In every case that I've mentioned, the informed opinion was we'd never get it done. And in fact, we did, and not obviously 100% in every case, but the bulk of everything I've just talked about will now become law.
Any doubt in your mind about the vote count in the House and in the Senate? Is this a done deal?
It is in the House because we don't need 60%, and the fact that we have no Republicans that have been willing to vote for it and who take incredibly to me the position that no new regulation is needed won't retard us. Senator Dodd has done an excellent job as both a substantive legislator and a vote counter, which you have to be. And he was conscious throughout of the need to keep 60 votes. And frankly, there were some things that I would have liked in the bill that aren't there, and one or two things that are there that I wish weren't. But I had to accede to the reality of the need for 60. In every case, we've done, I think, a great deal more than many thought we could. So I believe Senator Dodd is on track to get the 60 votes.
I know you and others believe that this legislation will make the financial system safer, perhaps reduce the risk of another financial crisis in the future. Is one of the other end results going to be that American banks are less profitable? And does that worry you if that's the case?
It depends. I'm not in the business to protect bank profits. To the extent that bank profits on things other than lending go down, no, I think that's a good thing. Banks were set up with deposit insurance, technically banks now, to accumulate capital and make it available to people doing things productively, largely through loans. Lending has become too little important. To the extent, by the way, I already helped get a bill through that has reduced the profits banks make on credit cards by raising interest rates on people retroactively. I'm proud of that. I think they've overcharged people on the fees. So yeah, I think, let's put it this way, an increasing amount of what's been done, not just by banks, we're talking about investment houses, we shouldn't single out banks, many of which do very good jobs. We have seen too much financial activity for its own sake, rather than for what it should be, a means to the end of productive capacity. And yes, I hope we will have shrunk some of this trading with each other on synthetic derivatives that look nothing, they look like fantasy football rather than having any real economic activity. So yes, I think would be a healthy thing if some of the profits made on some of those financial shenanigans that had no real connection to reality would have shrunk.
Let's talk about derivatives, because that was a key area of contention right up to the end. Senator Blanche Lincoln, we're told she was holding tough to her provision to force banks to spin off their derivative trading units. At the end of the day, that was moderated. Tell me why that's an appropriate balance to strike, and for those who suggest it goes too far.
I understand the media approach. Either it didn't go far enough or it didn't go too far. And I think the fact is, Senator Lincoln was perfectly satisfied with it. What people lost sight of, there were two provisions that Senator Lincoln came forward. The one that I had some trouble with, she acquiesced in on modifying. One was to push derivatives out of the banks. By the way, having pushed them out of the banks, you still had the equally, in some cases, more important question of how they were traded. If they're traded irresponsibly, AIG wasn't a bank, so getting them out of the banks wouldn't have resolved the AIG problem. But she also had in there a requirement for a fiduciary responsibility between people doing swaps, doing derivative trades with pension funds and others. They objected, the pension funds, not the financial institutions, and said, wait a minute, if we can't do business with people, they've got a fiduciary responsibility to us. That doesn't make sense. Let's have a better code of conduct. She acquiesced and we fixed that one. But on the basic part, on the derivatives, it's essentially what she asked for. But I want to stress again, there were two aspects of the derivatives. One was not to have them done in a way that had deposit funds at risk. But then, even more important, no matter who does them, they had to be made much more transparent. They had to have capital requirements, and I believe we have achieved that.
All right, let's talk about the Volcker Rule, the changes there. You did make some modifications, you and the other conferees. There is now going to be allowance for banks to invest in private equity firms and hedge funds up to 3% of their capital. There are large banks right now. My understanding, if you look at their balance sheet, that could be more than $3 billion.
It's interesting the way you phrase that. They could do it now. No, they have always been able to do it. What you're focusing on is the limitation and the severe restriction, and that's the problem. When Paul Volcker first came out with the rule last year, we in the House gave the regulators the power to impose it, and we had a tough fight, and people said, oh, you're going way too far. Then the administration embraced it, and most of the Volcker Rule is in there. So you are focusing on a small exception. And yeah, a 3% investment we don't think endangers the banks, especially since there are other restrictions. None of these things exist in the abstract. There are strict restrictions on derivatives. There are strict restrictions on making loans and then selling the whole loan. That risk retention, to prevent that, is a big part of this. So yes, I believe that what we've done here, a 3% maximum, is a perfectly reasonable one. The fear was that you might have deposit funds, insured deposits, endangered by this. I don't think a 3% investment is going to endanger it.
The president heads to the G20 summit now armed with the knowledge that you all have completed this work, a tough piece of legislation. You and others insist. At the end of the day, is there any risk? Are you worried at all that our international colleagues aren't going to come to the same distance, at the end of the day are going to have a lower standard and therefore put American banks at a disadvantage?
Well, again, I'm struck by the media's approach. One, a lot of questions about how it's not tough enough, but then we pivot immediately to it's too tough. We're used to the fact that to the media nothing will ever be kind of right. But no, I think what we've done at the president's request is empower him to do this. And in fact, I've had more conversations with international leaders now than ever before. My focus has been domestic. There is a widespread agreement at the European Union, in the United Kingdom, which is separate from the Union here. I've spoken to people in Canada and others to all move in the same direction. You are going to see there's not one government internationally that can do it and shouldn't be. But yes, there is general move in the same direction. For instance, one of the things I heard from my conservative friends here was setting up an independent consumer bureau is a terribly radical idea because you're going to have the consumer bureau not care about the safety and soundness of the banks. Well, exactly that was just done by the new conservative government in England. The people who threw out Labour and took over the conservative government just did exactly what we're planning to do there. On securitization, I remember talking to Charles McCreevy, who was the European Union minister, and we imposed a securitization requirement, and some said, oh, the money will go elsewhere. That is a risk retention. You can't make the loan and sell the whole loan. Mr. McCreevy said, thank you for doing that, because I've been trying to get it done, and once you did it, I could argue that we could do it too, and we did. So no, I think you're going to see, as a result of the leadership we've taken, and the president specifically urged us to get this done by yesterday, although there were other good reasons for doing it. It happened to be coincidental that we hit that day. I think you're going to see Americans' leadership lead to more regulation worldwide.
Mr. Chairman, you've got about 5 o'clock this morning, you all came up with a way to pay for this legislation. About $19 billion over 5 years levied on the largest financial institutions, banks Correct. And hedge funds. That sum of money, separate from any bank tax the administration has talked about to recover lost TARP funds at the end of the line. Do you still believe there's a need for a separate bank tax as well? I
think there may be. What we've done, by the way, is to require the financial institutions to pay for regulating them and for some of the damage they caused. One very important thing we've got in there, we had people who made bad decisions to borrow money, and we can't bail them out. I'm sorry that they did that. We can try to ease the pain in other ways. But there are people who made I'm talking about mortgages, people who made very responsible decisions to take out mortgages, and they can't pay them now because unemployment has been so much worse. Part of what we did is to set up a fund to lend them money, not give it to them, lend them money that they will be able to use to pay their mortgages and then have to pay it back. And I think it's fair to have the people who helped create the mortgage crisis pay for that.
That's a separate $4 billion fund, correct?
No, it's actually $2 billion in the bill. Net cost of $1.5 billion because people pay back some of that. That's all in the $19 billion that's to pay for. First of all, the amount we are asking the large financial institutions to contribute every year is almost certainly less than their bonus pool. Now, they can't tell us on the one hand that the bonus pool doesn't mean anything and these bonuses don't really hinder their ability to do things, but that an equal amount to support regulation somehow is going to cripple them. I believe there is room to get revenue from the banks over and above this, partly because our bill is only going to be in existence for 5 years. So this is a one-time $19 billion assessment. When that expires, and maybe even before, yes, there's room to increase the extent to which financial institutions contribute to the economy.
Sir, one final question, if I could. Fannie Mae and Freddie Mac, your Republican colleagues consistently through the course of this conference, and they did so on the Senate floor, House floor, have said one thing missing from this is a true examination of Fannie Mae and Freddie Mac and a solution there. You've addressed this, but when does that solution come?
Well, first of all, the first part of the solution came. My Republican colleagues like to forget the fact that during the 12 years that they controlled Congress, they did nothing about Fannie Mae and Freddie Mac. They were frustrated whenever they couldn't do it. When the Democrats took power in 2007, working with the Republican Secretary of the Treasury, we passed the bill that gave him the power to put them in a conservatorship. So Fannie Mae and Freddie Mac today are not what they were. Thanks to a bill passed by a Democratic Congress with the cooperation of a Republican president, they're in conservatorship. So this notion that we haven't done anything is a lie, and they know it. The question is, having put them in a conservatorship, having restrained them from the bad behavior that they unfortunately turned out to have been engaged in, what do you do going forward? And here, what we need to do is to restructure housing in general. So we plan to do that. The Republicans, while they have talked about this, have no plan. And when we said, well, how soon do you want to do this? They said, well, 3 to 5 years. Yeah, we're on track to do that. So we have put them in a conservatorship. They do not now resemble what they were before. And we now will turn to trying to figure out what replaces Fannie Mae and Freddie Mac. If you will not have this hybrid public-private, you'll have some public entities, some private entities doing housing finance. Every private and public group concerned with housing, the realtors, the home builders, various bankers, low-income housing advocates, municipalities, all say to us, please don't just abolish them. Of course, we need to restrain them, as you have through the conservatorship. Let's work together to get a system to put in its place, and that's what we're doing.
Chairman Frank, thank you for the time again on very little sleep. We appreciate it very much.